When we hit 27, all bets are off. That is the long-term 12-year cycle coming to play, and the stock market might have a big correction. Gold might have a big correction. In fact, this pause that we saw back before 2008 financial crisis, there was a multi-year pause. Right after that, we saw everybody pile into gold just before the financial collapse in the economy topped. And then gold pulled back 34%. Well, we just had that right now. We just had a multi-year pause. And now everybody's piling into gold as that defensive play. We're almost at the target. And then I think we go into a potential recession bear market, and it'll pull gold down potentially 15, 20, or 30% again. And then it's going to be queued up for the ultimate precious metal.
As gold continues its remarkable ascent in 2024, financial market analyst Chris Vermeulen forecasts even greater heights for the precious metal. Vermeulen, known for his expertise in technical trading strategies and long-term market cycle analysis, suggests that gold could reach $2,700 per ounce within the next 1 to 2 months. Since the beginning of 2024, gold has already posted impressive gains, rising 21.75% or $448.62 per troy ounce. This surge has brought the commodity tantalizingly close to Vermeulen's predicted target, which he bases on Fibonacci extensions and a 12-year cycle pattern. The Federal Reserve's dovish stance has further fueled the bullish sentiment for gold. On Friday, gold rebounded above $2,500 per ounce, approaching the record highs set earlier in the week. Traders are now pricing 100 basis points of rate cuts for the Fed's remaining 3 meetings this year, which typically boosts non-interest-bearing assets like gold. Trading Economics global macro models align with the bullish outlook, projecting gold to trade at $2,464.46 per troy ounce by the end of the current quarter. This forecast, coupled with Vermeulen's analysis, paints a picture of continued strength in the gold market. However, Vermeulen cautions that reaching the $2,700 mark could trigger significant market shifts. He anticipates a potential multi-year pause in gold prices following this milestone, accompanied by a significant correction in the stock market. Moreover, gold might experience a substantial pullback, ranging from 15% to 30%. Despite these potential headwinds, the short-term trend for gold remains decidedly bullish. As the saying goes, the trend is your friend, suggesting that long positions may continue to be favored over shorts soon. Please tune in for our exploration of Chris Vermeulen's expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. We appreciate your support.
Yeah, so what's interesting, and bonds have been out of favor for years. Gold has been now on a tear. It really has been the play for the last several months. And you and I actually talked several months ago, and I was talking about, I think gold, the long-term picture of gold going back 20 years actually has been pointing to 2,700. I actually on this chart have several things lined up here based on the last major super cycle low in the price of gold back in early 2000 to the 2011, 2012 market top, and then back down. This move based on technical analysis using Fibonacci extension, which sounds complicated, but it's not, points to $2,700 an ounce. So this is something I've been looking at and been expecting for a long time. But this is like a 12-year, this was a 12-year bull market, a 12-year cycle. And here we are, 2024. This is the next 12-year cycle coming to play. And we're about to get up to 2,700. I think we're 1 or 2 months away tops from gold hitting that. So we are very close. I think it's on its way right now. And when we look at the shorter term price action, which is the white line here, this is just the shorter term price pattern, a bull flag pattern. It also points to about 2660 or so. So right now, gold is on a tear. Even when we drop down to the daily chart pattern also points to 2,700. So there's 3 different major time frames, 3 different chart patterns, all pointing to it. It really is kind of like the lowest risk, highest opportunity play in terms of the odds of it working are very well, are very good. We've been, talking about this for many months, and I think we're going to hit it. Now, the question is, when we hit 27, all bets are off. That is the long-term 12-year cycle coming to play, and the stock market might have a big correction. Gold might have a big correction. In fact, this pause that we saw back before 2008 financial crisis, there was a multi-year pause. Right after that, we saw everybody pile into gold just before the financial collapse in the economy topped. And then gold pulled back 34%. Well, we just had that right now. We just had a multi-year pause, and now everybody's piling into gold as that defensive play. and we're almost at the target. And then I think we go into a potential recession bear market, and it'll pull gold down potentially 15, 20, or 30% again. And then it's going to be queued up for the ultimate precious metal rally, very similar to that of 2009, where it's a multi-year run. We see gold, precious metals, and miners scream higher. So I'm bullish short term, super bullish long term, but there's going to be a pullback along that way first. When it comes to the gold market, I think when the stock market starts to sell off and we start to see a lot of fear and a level of fear that actually starts to pull gold down with it, because typically when there's fear, we see gold go higher. People move to that defensive play. But when there's enough fear, too much fear, people liquidate everything because they're just scared. They don't know what to do. They don't like the pain. So they will start to sell gold. So if we see the stock market fall with a lot of volume, gold could follow suit with that. And that'll be an early warning sign that, hey, there's real selling going on. The masses are starting to panic out of positions. And that could be the start of a pretty big slide for the gold and the equities markets.
The U.S. bond market experienced a significant rally following Federal Reserve Chair Jerome Powell's speech at Jackson Hole, Wyoming, in which he strongly hinted at upcoming interest rate cuts. This development vindicated bond investors who have been positioning themselves for a shift in monetary policy. Treasury yields responded swiftly to Powell's remarks, particularly on the policy-sensitive 2-year notes. Yields dropped by as much as 10 basis points to 3.90%. As Powell stated, the time has come for policy to adjust. This language was interpreted by many as a clear indication that the Fed is preparing to ease its monetary stance shortly. Chris Vermeulen had anticipated this shift. Based on his chart analysis, Vermeulen asserts that bonds have already entered a new bull market, even before the Fed's official announcements. His foresight highlights the predictive power of technical analysis in anticipating major market moves. Looking ahead, Vermeulen projects an optimistic outlook for bonds. He suggests that bond prices could rally by 15 to 20% in the near term, a significant move that could provide substantial returns for investors. Let's get back to the interview.
I'm a technical trader, so I don't follow the news. I don't put any of that into any of my trading or investing, but I follow the charts. And the charts tend to lead the news because there is smart money out there and savvy investors more or less front run the idea of what's going to happen. If we take a look actually at the TLT chart, you can see here, this goes back to the COVID spike that we saw. TLT dropped 53, almost 54% for investors, which is devastating for a lot of people most people hold a lot of bonds in their portfolio, whether it's 60 or 40%. It's usually a heavy weighting. People have been annihilated with the drop in bonds. But what's really interesting here is these blue down lines that we see. These are waves of people moving out of the space. And this is like people distribution selling. This is steady outflows of the bond market driving it down. But what's really interesting is this white line that's curved. This is a very simple signature pattern. There's 3 surges to a low that happened over the past year. And this signifies that the market is actually starting to put in a bottom. That coupled with volume starting to increase, the underlying technicals of the stock market and of the interest rate, the bond market, all these things are coming together. And bonds actually just in the past week generated or started a new bull market based on my analysis. And of course, this is before the Fed came out to say this, because the market generally knows what's going to happen before the news comes out. News is old news, as they say. That's how I see bonds. And bonds are going to be an opportunity, I think, this time around versus, in the last few years, bonds and stocks fell together, which was hurt a lot of people. I think bonds have got potential to rally, 15, 20% fairly easily. Wow. We've seen pullbacks of 20% in the past many, many times, rallies of 20% as well. If you go back over the last, 20 years, it happens actually fairly frequently. So I think we could see an easy 20% move in the price of bonds. And then I do think we're probably going to see potentially multiple years of bonds moving up or at least holding their value, because I think rates are going to go down and then kind of flounder. I don't think they're going to go down a lot, but they're going to go down, and that'll keep the bond price lifted and elevated. The question is, how far are they going to go? I don't think they're going to go to like zero interest rates again, but I think there's some pretty good upside in the bond market.
The coming months may offer unique opportunities for those who can navigate the shifting tides of both the bond and precious metals markets. However, as with any significant market shift, caution and thorough analysis remain paramount. Investors would do well to consider how these developments align with their long-term financial goals and risk tolerance. potentially reassessing their asset allocation strategies in light of these emerging trends. Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.